Hello, welcome everyone. It is Thursday. It is the 21st of May. We were in our PUG membership group, our user group yesterday, and one of the members had asked if we could go through the settings on the 5-minute ES strategy that we posted on YouTube months ago. The whole thing is to look at a market and an algo strategy, which as you guys see from today, it had a long, it took another long, and these are blue lines are profitable trades. It stopped out on a trailing stop function, and it went long, and it stayed in that long position all day, and just went short again, and I had to shut the room down. So you guys that are in the room, you know that this is still the active trade, and it'll be out before, or either out with a big profit, or out with a loss, or it'll be out by the close. Either way you look at it. So the moral of the story is what I wanted to do is go through and optimize a program and compare the two. So tomorrow in the live trading room, I'm just going to go briefly right now. Let's take a look at the settings. This is one that I created for you guys now with less profitability, smoother equity curve. Let's look at the performance. So first and foremost, it has, let's just get down to the nitty gritty. And let's see, return on capital, 28%, buy and hold return in that same period. And look what the date is, from 225, right before the crash. So I want to include the time period when the volatility exploded. It's tough to take a backtest model and use a algo strategy when you have the most historic daily trading ranges in history compared to the smallest on average ATRs. In December, we were at about a 30 ATR handle. That's average true range handle. 5-year average is around 29 points. So, you know, December 30 points today is like a slow night session, right? In fact, I think during the day right now, we have a 10-day average true range of around 78. So we're starting to decline. To put things in perspective, we went from 30 in December, 32 in early February, and in March, we had a 10-day ATR registered reading of around 243 S&P points. That's unbelievable. And so being at around 70, a little north of 70 right now, we're still twice as much as we normally would be on a 5-year average, going from 2013 to 2018 time period in that range. All right, and that's some of the work that we had already posted months and years ago. So any event, and I think one of our other members Googled me on that, Brett in Hawaii. So and actually back tested that and did that as well for the room. That was nice of him. All right, so here's the story. I'm just going to cut to the chase, and you can figure this out. This is a model that starts now at 7:15, subtracts 110 minutes from 2 o'clock, so it doesn't take a lot of trades after that time period. So it'll stop taking afternoon trades. Here is your exit end of day. The position size still 2. Max trade loss 1100, 1350 max profit. Max losers 3. Starts trailing the percent of the when it's getting close to its profit target. So I want to explain this. So when you get a short, you have your initial stop. When the market starts to move closer to its intended profit target, it'll jam an emergency stop in there. These other dashed gray lines are the trailing stops, which we'll get into in just a second. You'll see right here, dynamic and compression. So this model uses 2 different stop backup strategies, a dynamic and compression. All right, next. Customizable exit. It adds 8 ticks of risk. 8 ticks. You can always optimize, should I be adding more risk? So that way it may avoid a market that if it, for example, if you're long the market sometimes, or short the market, or in a position, sometimes you get a false breakup and then slams right back down against you. By adding a couple extra ticks, you can optimize that function. In this model, this is where it's at. We have, going down forward here, we have reverse signals, yes. We have PPS buy. 0 is false, 1 is true. Risk reward, 5.5. So again, remember when this model started, before the crash. So this is taking a big downdraft and a big recovery, and now this kind of like narrowing trading range, which is why we see that compression or contraction in ATR. So it's taking a full boat. And by the way, let me jump back over here and show you something on a 5-minute scalping, and that's pretty much what this is, a 5-minute scalping model. Total number of trades in this time period is 198 trades. Combined longs versus short, averaging out 58% profitability, and your profit factor 1.5 on longs, 1.24 on shorts. All right, so the performance graph again has some, it's a little bit smoother. Drawdown period, not as profitable. All right, so I just wanted to bring that to your attention. So let's go back and look at the rest of the settings. It optimized out in this movement as using an 11-period moving average by the close. So it will not take a buy signal unless the PPS buy is above 11-period moving average of the close. There's the added filtering function of a long. All right. What else am I missing here? Nothing. There it is. Why do I know that's a close? Because the number is 3. A high would be 1, a low would be 2, and a close is 3. Next, PPS sell. Yep, but the sells only have a 1.75 risk-reward ratio. It will only take a short if it's below a 20 period. Now, this is weird because, I always like if it's going to be a trade strategy, something that makes logical sense to me. So it's generating a sell signal only if it breaks below a 20-period moving average of the high. I would assume that we would get something like 20-period moving average of the low. You can actually change and hardwire change these. In other words, you can go into the setting and actually change that if you want and not even use it. I'm just sharing with you what it optimized out as best performance with these strategies. Again, the thing about the Algo 17, you can have a model that's long only, short only, trades certain times of the day, and since we are having a model inside the trading room, we want trade setups and signals while the room is open. So that's what this model does. All right, so I'm giving you guys a choice. It does not take high and low close dojis because on a 5-minute period, there's too many bars that dojis don't show up, and too many bars, like as you can see right in here. 1, 2, these are 3, 4 dojis in a row. So almost every bar is a doji. And we don't like using a high and a low close doji when lots of dojis exist and are populated in a chart sequence. So therefore, these are turned off, all right? Especially on a 5-minute model. So that's what this is. Why are we using a 5-minute model? On a 70-point ATR or a 240 ATR or anything out of the norm, you just can't look. Every 5-minute bar, you can see, here's the bottom of the ATR. You can see that we have an extreme 6-7 point moves. Every 5-minute bar is like $350 worth of movement. So if you have to have a stop 3 bars back, you're talking 3 times 6, 18 handles. Not many people want to take a 18 handle, right, which is $900 risk on a 1 lot for a day trade. That's a lot of risk, but that's the market condition we have. All right. So if you want filtered out day trade strategies that you can lean on, this is a strategy that's fairly robust, and we'll get down to the rest of the strategy settings here. Again, low close doji, it's set at 0. We have a max trading bar set at 15, and it trades. Enter trade market order. It's not taking a market order. What this strategy does is if it gives a signal, it's placing a buy stop above the high of the entry bar, and after 4 bars, if it don't pop through that level, then the trade's negated. So 0, 4, that's the difference there. And then draw lines, that just gives you your lines. So for example, in this model, friends, here's your long, here's your stop, here's your profit. As the trade progresses, then the stops kick in. That's what these gray lines are. The stops kick in, and it trailed out. It didn't quite hit its profit target, and it's out. This does not scale out. This gets out of everything at once. All right, so there's that model that I had told you that I would run this performance. And here is another function. I don't remember who asked me this question in the PUG meeting. They said, do you use the RANI performance index? RANI is a proprietary index, kind of like a Sharpe ratio for risk, measuring risk to reward ratio and drawdown function. It's proprietary to TradeStation. And as you can see, it kind of combines the total net profit, time in the market, drawdown, and the higher the number, the larger the number, the more efficient, risk adverse the strategy is. So number one, that's one thing you can kind of look at. And in this case, the RANI index is 307. So it's a pretty high number to be exact. It does have a decent return on account in the last, again, almost 3 months. That's 90 days in the most historic trading environment we've ever encountered. Here's your performance graph once again. Trading 2 lots only between those hours. So this isn't taking anything in consideration end of day, overnight, just day trades, 5 minute between those hours. Not that bad. All right, how does that compare to the current model that's in the room? And where did we go? Let's go back to the day trade room. Here we go. There's the day trade room. So let's go back to the day trade model. And as you can see, it is 448. We still are in a short position that it's been in. If you were in the live trading room today, you know, this is the model. Let's take a gander. There has been, from peak to current, a lot more trades on this model. And this was the one that was posted a long time ago. Let's take a look how many trades. 379. Again, it's more profitable, but at what expense? And that's the key that everyone has to look at. This is almost double the profit with more risk. So this is more of a, you know, if you're less risk adverse, or meaning you don't want as much risk, the new model will be the one for you. So bottom line, the RANI, here it is, at 413. So it is a better model, but comes with more risk. Now, let's say, for example, you weren't here at the beginning of February, or excuse me, the beginning of March to trade this, and you started to trade at a drawdown function and started to trade at a peak performance. You're not going to like this strategy, that's for sure, right? So anytime you start at a peak performance and you get a drawdown, it's not going to be wholesome for anyone. I mean, that is a big number to go from May 13th straight down. Periodic returns on a weekly basis. This week, overall, it's a loser. Last week, up 7,000, 3,000, 14, 15, 14, 17, 20. So it's been a big winner in those months. So what does that signify? This strategy did better in higher ATR environment, and it's not doing as good in a lower contracted trading range environment. That's what that means. So it's time to do maintenance. So bottom line, you can get chopped up. Has a great trade yesterday, as we said. We started off the box yesterday, great trade, and I said, hey, after a strong trend, we're going to probably go through a consolidation period. And so after you get a nice trade, unfortunately, people think that this is going to just continue to grind and make profits. Well, that doesn't happen. And I want you all to understand, in a book that I wrote, and let me get it for you. So in this book, and you'll see there's a lot of markings here. Why? Because it's been in the process of having a second edition written, which it's in the editing phase. It actually got done. So it's on the phase. But if you look here at, and I don't know if you can see this closely, you see that page right there? Trend consolidation. We're either going to resume or we're going to reverse the trend. After a strong trend, you go through consolidation. I mean, I wrote the book 15 years ago, friends. And here you go through a trend in the market, and then what do you get? Consolidation. And what happens to trading systems? Drawdown. So you got to kind of measure after a nice trade setup and a nice run in the market. should you allow your system to continue to run all day long? That's the million-dollar question. If you don't mind drawdowns, go ahead. I always tell people to have a little cerebral thought into your systems, and that's why in the live trading room, we have the different various models. When we trade the ES, this 5-minute model, friends, we also have right down here the SPY with the advanced decline. Here's the advanced, there's the decline, and the volume trends. If the volume trends are not conducive for selling, then maybe when you see the system fire off, perhaps you don't want to trade. Next, you know, I use the term boast because I think some of these strategies that we have, this is a SPY since 2018, significant, I wouldn't call it a drawdown, but inactivity in the marketplace, summary performance. When you look at some of these strategies in this environment and you say to yourself, the RANI index on a SPY trade is only 55. Against a futures of leverage, it's probably not that good. Buy and hold in the market, 4%. Our model up 33%, 500% return on the account. If you look at these statistics, that's why I think that the Algo optimizer definitely puts the edge in clients' pockets and the edge in retail traders. So we put up maybe one too many strategies to help people out. We have the SPY system. We have SPXL. Again, performance graph, little choppy, not smooth. This is a leveraged ETF. This goes back since 2017. And once again, performance, buy and hold. If you bought SPXL since this time, you'd be down 16% of your equity, not up 72%. Or the return on account, 238. RANI index at 50. Not bad for a leveraged cash ETF. Now, how much has it been in the market? Probably less than, well, 47% of the time. So there is some really good news here. The VXX, we put up two models, 120 minute for higher time frame. This goes back since January of 2018. Performance summary, same story. Stuff to be proud of. And if you're only looking at trading a 5-minute model and that's all you're trading, then you need to heighten your awareness that there's going to be good times to trade and bad times to trade. Any professional trader will tell you, you know, after a big run of equity, markets tend to kind of dig back and regress a bit. And let's take a look at that based on the spider, and I'm going to change this over to a daily basis because I think you can't expect the market to give you the types of profits that we saw in March and April because the ranges were outrageous. So, you know, we're going through a transitional phase from normalization ATRs to hyperbolic expansion volatility ATRs to now trying to figure out what the norm is, the new norm, so to speak, right? So let's go over here to a time frame, and I'll go to daily chart, and let's just take a look. So I ran these studies since February. This was more of the new norm, right? Now, here's what happened in the market since February. Down, up, down, up, down, up, down, up, wild, wild, wild west, up, down, up, down, up, down, up, down. And then what has the market been doing over the last 30 days or so? Ironically, no trend, sideways. What's the equity done to reflect that in the market? Kind of the same thing, right? It's not really going tremendously well. So you have to look at the condition of the market when you put things together for yourself as a trader. When you've had a really good run in the market, maybe take a back seat or switch gears and look at other markets. I hope you found this helpful, and I hope that sincerely between the two models, we will discuss this and carry the discussion up in the live trading room tomorrow. And with that said, have a great evening. It took a little while today, but we had, again, a lot of things going on, as you know, behind the scenes with our trading room, J-Person Asset Management, and wearing a jack of all hats. You're going to have thunderstorms, potential lightning, and internet outages, and all that kind of good stuff to boot. Thank you all for listening, and I know this went a little bit longer than I intended, but I also wanted you to get the parameter settings in your hands, and that way you could start to develop your own strategy and maintenance program, and hopefully that gives you a better insight as to what you want and need to do for a maintaining of a program. Thank you for watching, and I, again, welcome your feedback. Thank you.